When it comes to wealth generation, have you ever considered generational wealth? Thinking about your kids, your grandkids, even your great grandkids, how can you set up a legacy that is so big and so really rich that you can have generational wealth? That is something that I'm focused on when I think of my parents, my grandparents, even my great grandparents. The generational wealth was not there, but it's time to break the chain. And that's exactly what we're going to be talking about in this video. When I was growing up, I had a single mom. It was a single parent household. We lived well below our means, making sure that we were really stretching our budget and making the most of everything. When I went into my 20s, I joined the military, spent a couple of years there, and it wasn't until about 35 that I got really serious about wealth generation. And I want to share with you some of these really important tips to generating wealth. Now, of course, it starts with managing money. When it comes to budgeting, when it comes to really every dollar has a purpose. I know it's an old slogan, it's from Dave Ramsey, and overall, it is very intentional about what you do with your money. You're not spending it frivolously. You're not looking at having a bunch of things and really owning a ton of different things because, of course, unfortunately, you can't take it with you. But as we surpass $1 million in our portfolio, we want to make sure that we have generational wealth. And I think of this as constantly and consistently acquiring assets. When I think of 401k, when I think of HSA, when I think of anything, stocks, real estate, anything that can generate wealth and that can generate wealth or have a monetary value in the future. This could even be card collection, art, think of Masterworks. There are so many different ways that you can acquire assets that are going to generate wealth and going to generate wealth in a really big way. When you start doing the compounding aspect, where if you're 20, if you're 30, when you think of the next, 30, 40, 50 years of wealth generation, as you're passing things on to your kids, even starting and getting to the point of their wealth generation and getting and really growing their nest egg, growing up everything and investing at a very young age makes a big difference. Now, I invest in ETFs and only in ETFs, and I track the S&P 500. Something like the VOO is perfect. It gives me an index fund. It is perfectly diversified. And of course, it mitigates a lot of risk through years. But thinking again, at my age, if I have another 40 years and I can put 40 years of growth into a portfolio just to pass it on to my kids in the means of being like a Roth IRA or Roth 401k, that could make a very big difference when you're generating passive income for years to come. Now, of course, to generate that passive income, we have a really big advantage, and it is looking at anything that can give you tax advantage or tax savings, because the less money that you're paying to Uncle Sam, the more money you're keeping in your pocket. Now, for me, this was my 9-to-5 job. This was a big opportunity looking at my employer's 401k match, looking for pre-tax contributions to HSA accounts, and HSAs are triple tax advantage. I feel like most people really underestimate or undervalue HSA accounts, guys. If you're not maxing these out in your entirety, you are losing so much money. Not only the growth factor from having an HSA invested, but also looking at the factor of making contributions, getting the taxable deduction. Now, if you're like me and you're in a 24% tax bracket, every dollar I'm putting in, I'm getting 24 cents back on that. And then we have the growth factor of the HSA. Now, when it comes to retirement, when we're fully retired and we can't do contributions to an HSA, that is going to be the supplement to Medicare, Medicaid, to Social Security in general, meaning we're not going to have spend our hard-earned money during retirement covering medical expenses because the HSA is already going to be there. Now, it is estimated that at the age that you pass, between the retirement age and the age that you pass, you will spend about $70,000 in healthcare costs, which I know is kind of crazy to think, but being realistic and knowing to be prepared for that can make a big difference. Now, of course, number 3, we look at preparing for the unexpected or building that emergency fund. This is where I feel like a lot of people and the generational wealth really do go away. When you start looking at keeping up with the Joneses, having the bigger and better, buying the larger car, it's not the 30,000, it's the 80,000. It's not the 80,000, it's the 150,000. Really setting up an estate planner, having life insurance in place, knowing exactly what you're dealing with, and having a family trust. Not just an individual where it's just going to be for you, but something that is going to go to the kids again and the grandkids, knowing exactly where the money is going to be and how it's going to be allocated for their entire life through an estate plan can make a big difference. This could include paying for college, making down payments on a house, starting a small business, distributing the money gradually. That way the money is not gone. Now, what I see a lot of times is when people run into money, whether it is through, they're finally retired and they get all of their 401k money, or they hit the lotto, something of that nature. When you start looking at most people that get an absorbent amount of money in one big lump sum, most of the time it is gone, and it is gone very quickly because they don't know how to really manage any of it. If you think, again, Dave Ramsey's philosophy of when you have a golden goose, let's say you have a $3 million portfolio and you're getting dividends on that on a regular basis, could be monthly, could be quarterly, annually, whatever it is. If you can live on the supplement of Social Security and those dividends without ever touching that principal balance, only living on the dividends itself, or even taking some of those dividends and reinvesting them because you don't have any debt. That is one of the biggest things when it comes to generational wealth. And when it even comes to people that I see that do pass, leaving their family with, mortgage payments, leaving them with loan payments, unsecured loan, visa debt. There are so many things where if you're living debt free and being on the other side of the fence where you're getting paid interest, you're getting paid dividends, you're actually generating assets and generating money versus where if you have loans, you are paying interest on them. Now, of course, gradually doing this over time makes sure that your trust isn't completely liquidated when you pass, giving an opportunity to pay back the trust to keep money going for future generations, which is exactly what we're talking about. Now, of course, the last one in here and the biggest one that I feel is the most important is the foundational basics of talking to kids and talking to your family about money. That is the way you really build wealth and really build literacy around wealth creation. When you start looking at your ticket, when you start talking to your children, thinking about it's not a blank check. We don't have infinite money. It is a finite thing. You're not going to have a lottery ticket, but setting them up for success through education. Now, when it comes to your traditional, K through 12 school, unfortunately, financial literacy for a majority of states is not there at all, meaning you get out of school after 12 or 13 years with zero financial literacy. I see people, and I do financial education and counseling. I see a lot of people that are 18, 19, even early 20s that have zero financial literacy. They don't know nothing from bank accounts to how investments work to making contributions into IRAs, 401ks, HSAs. It is kind of crazy that they have nothing at all and they have no foundation when these are the individuals that are just starting in the careers, just starting in the working world, and they have no idea. Now, of course, when it comes to older kids, really getting them an allowance, starting to build it, and really breaking it into giving, needs, wants, savings, and investing. If you have kids that are investing at a very early age, and I think about this myself, if I invested at 35, if I have kids that are investing at 18, even the time frame between the years of 18 to 35 is going to be a time to get an incredible amount of compounding in those investment portfolios. When you start thinking if you're starting at 18 and you're retiring at 65, through all of those working years, you can build a nest egg that is so big. And of course, it could make it super easy if college is paid for, if down payment for a house is paid for, if a lot of the regular traditional expenses that people really fall victim to, meaning they are stuck in payments. When you think about interest on a mortgage, interest on auto loans, interest on your student loans, interest on personal loans, Visa cards, credit cards, everything you're paying interest on, if you can eliminate that with generational wealth, it is going to be a game changer literally forever as they have kids. And then, of course, kids of kids, generational wealth can be built. So guys, that's going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.